You can follow every money rule, save aggressively, invest early, work harder than everyone else, and still feel like you're standing still. That's because money doesn't follow rules. It follows laws. Rules are suggestions. Laws are non-negotiable. Today, we're breaking down the 7 laws that determine whether money compounds in your favor or disappears. Let's get into it. Before we get to the laws, you need to understand the system. Building wealth requires 3 components working together: momentum, how do you make money compound faster; structure, who controls the money and what outcomes do you get; and asymmetry, how do you maximize upside while minimizing downside. When these 3 work in sync, wealth isn't just possible, it's inevitable. Now, let's look at the laws that make this system work. Law number 1. Money loves speed, but wealth loves time. Let's look at 2 approaches in real estate. The first investor focuses on flipping. They find a deal, renovate it, sell it, take the profit, and move to the next. Over 5 years, they flip 100 homes. They make good cash along the way. The second investor starts with one single-family property. They hold it. A few years later, they buy a 4-unit building. They hold that too. Then they recapitalize and buy a 20-unit complex. At the end of those 5 years, the flipper has cash in the bank, but the second investor owns 20 units. Their net worth is 5 times higher. Speed is the shortest distance between seeing an opportunity and acting on it. You need fast action. Time is making a good decision and letting it compound.
Law number 2. He who gives the money has the power. When a business is sold, who makes more, the seller or the buyer? In most cases, the buyer goes on to multiply the value many times over. Why? Because buyers unlock value. Facebook bought Instagram for $1 billion. Today, it's worth over $45 billion. Google bought YouTube for $1.65 billion. It's now the 2nd largest search engine in the world. The Forbes 400 list tells the same story. How many people made the list purely from earned income, from a salary? 0. A small number made it by selling a business once, but the vast majority, they buy and build. They continuously acquire, grow, and compound. Even in real estate, if there are no buyers, there's no market. Buyers wield the power because they control the terms. Understanding this strategy doesn't mean you need billions in cash. It means shifting your mindset from seller to builder, from transaction to ownership. Law number 3. Leverage multiplies everything. Leverage gets a bad reputation, but it's simply a tool. Used correctly, it amplifies results. Take $1 million home. If you pay all cash and it appreciates 10%, you've made a 10% return. Solid. Now imagine you put $200,000 down and finance the remaining $800,000. That same 10% appreciation still gives you $100,000 in value increase, but relative to your $200,000 investment, that's a 50% return. That's leverage. It multiplies outcomes. This same principle applies at the highest levels. Instead of selling assets and triggering taxes, wealthy investors borrow against their existing holdings, using those assets as collateral. No sale means no taxable event. They get liquidity without losing ownership. Leverage is the engine behind private equity, commercial real estate, and most large-scale wealth creation. But key rules apply. Leverage requires collateral. It works best when downside is capped. And since borrowed money isn't income, it doesn't trigger immediate taxes. Used wisely, leverage doesn't just multiply returns, it multiplies opportunity. Law number 4. Cash flow keeps you alive. Equity makes you free. Cash flow is what funds your life today. Your housing, your food, your daily needs. You need it to survive. But cash flow alone won't build long-term wealth. Equity is ownership. It's the value that grows while you sleep. The most direct path to equity is owning your own business, but the second best path is owning a piece of someone else's. Consider McDonald's. Most people think they're in the burger business. They are, and that generates substantial cash flow. But the real wealth comes from equity. McDonald's owns the real estate under thousands of franchises. That portfolio is worth nearly $45 billion. The principle is simple. Use cash flow to acquire equity. One sustains your present, the other secures your future. Law number 5. Risk and reward are nonlinear. Most people assume risk and reward move in lockstep. More risk, more reward. But the most successful investors understand that the relationship isn't linear.
It's asymmetric. Imagine a venture capital portfolio with 5 investments of $100,000 each. Total at risk, $500,000. 3 go to zero. 1 breaks even. 1 goes 100x. That single winner returns $10 million. The portfolio isn't just profitable, it's wildly profitable. Even though most individual bets failed, the structure worked because upside was uncapped, while downside was limited. The goal is to enter situations where you can lose what you put in, but potentially gain many times that amount. Asymmetric opportunities exist in business ownership, real estate with leverage, and certain investment structures. The key isn't to avoid risk, it's to ensure that when you win big enough to outweigh the losses.
Law number 6. Don't bet the empire for a pot of gold. There's a story of a couple who spent 15 years building up $700,000 in savings. They were introduced to an investment opportunity that looked exceptional, strong returns, tax advantages, promoted by someone they trusted. They invested everything. 2 years later, the investment collapsed. 15 years of savings gone. The problem wasn't necessarily the investment itself, it was the sizing. You don't risk your entire foundation on a single opportunity. The best investors focus on managing risk, not just chasing returns. Ray Dalio, founder of Bridgewater Associates, emphasizes a counterintuitive approach. Instead of trying to increase returns, focus on reducing risk while keeping returns the same. If an investment offers a 12% return with a risk level of 100, the goal is to find a way to get that same 12% return with a risk level of 70 or 60. Protect the machine that generates opportunities. Once the empire is gone, the game is over.
Law number 7. Diversification is a hedge against ignorance. Wall Street often preaches diversification as a universal virtue. But look at the wealthiest entrepreneurs and investors. They don't spread their money evenly across dozens of assets. They concentrate. Why? Because diversification makes sense when you lack 2 things, understanding and control. High understanding plus high control, concentrate, your business. High understanding plus low control, invest selectively, public stocks you know. Low understanding plus high control, hire operators. Low understanding plus low control, diversify. When you deeply understand a business and have control over its outcomes, like the founder of a company, concentrating makes sense. You know more than the market. You influence the results. When you understand the risk but lack control, like investing in a publicly traded company you've researched, selective investment is reasonable. But when you have neither understanding nor control, that's when you diversify. Spreading bets protects you from what you don't know. The wealthy don't diversify out of fear. They concentrate where they have insight.